Thank you for joining us for a fireside chat with Evolution Petroleum's Chief Executive Officer Kelly Loyd, Chief Financial Officer Ryan Stash, and Chief Operating Officer Mark Bunch. Before we begin, I would like to remind participants that our discussion could contain forward-looking statements as of today, September 24, 2025. Evolution's disclosures regarding forward-looking statements can be found under the Investor Relations tab of its corporate homepage. The company's current asset base includes a diverse mix of non-operated working interests and mineral and royalty interests in producing properties located across multiple regions, including the Permian Basin, Mid-Continent, Wyoming, and North Dakota. The company's strategy is built on growing its long-lived asset base through producing property acquisitions and low-risk organic investment, while maintaining a conservative balance sheet and returning cash to shareholders. As of June 30, 2025, its fiscal year-end proved reserves totaled 27.1 million BOE, and production for the June quarter averaged about 7,200 BOEs per day. Kelly, with Ryan and Mark, I want to thank you for taking the time to join us today.
Yeah, thank you, Jeff.
Yeah, thanks, Jeff. Appreciate it.
Evolution closed a $17 million acquisition of mineral and royalty interests in the SCOOP/STACK area of Oklahoma on August 4 of 2025. The transaction added about 5,500 net royalty acres with 420 gross producing wells and 650 potential development locations across an acreage position spanning some 140,000 gross acres. As of the effective date for the transaction, which was May 1st, 2025, net production on the assets was about 420 BOE per day. Kelly, let's start with the acquisition. Should we think about this deal as an opportunistic transaction that arose from Evolution's existing position in the SCOOP/STACK, or are you trying to broaden your business development efforts to now include mineral interests?
Yeah, so thanks, Jeff. Look, a couple things. First, to directly answer your question, yes, we should think about this as an opportunistic transaction. As you know, we've got great knowledge across the SCOOP/STACK, given that we already have a significant asset there. And so adding these royalty acres and production, it's a great complement to that. Second, people may not realize this, but we do already have some royalty interests, specifically like in Barnett and Delhi. So while, yes, this is our biggest sort of minerals only deal to date, but we've reviewed and transacted on mineral/royalty deals, in the past, and we do consider royalty acreage as an ongoing piece of our business development effort. So it sort of stands out because it's our biggest minerals only deal to date, but we've bought other things that have royalties and overrides and minerals in them. So we look at those all the time.
Can you share some color on how the transaction economics on this royalty acquisition compare to some of the traditional non-operated assets, which have really been the mainstay of Evolution's acquisition focus?
Yeah, sure, Jeff, I'll take this one. When we looked at this deal, just as with any deal we look at for the company, we always ask, is it going to be accretive to cash flow per share and essentially our dividend, right? And we definitely think that's the case here, especially because this asset has such high margin cash flow and no CapEx associated with it being minerals and royalties. For this specific asset, the valuation itself, we focus primarily on the PDP, where they're producing wells, and the remainder of the package is just largely upside for us that we're definitely excited about.
Evolution got its feet wet in the SCOOP/STACK in February 2024 through the non-op acquisition. Is there much overlap with those assets in this royalty package?
Yeah, I mean, there's definitely some overlap in there, but there's also quite a bit of new acreage in the SCOOP/STACK play that we're excited about. I mean, clearly our existing position did help us in evaluating this opportunity and asset, but there is some new locations that we're excited to see what's going to happen with them on the development.
You mentioned that the new royalty acreage footprint has about 650 future development locations, which is a pretty deep inventory. Mark, can you share any information on how much activity is taking place on the acreage in recent years, and do you have any insight into plans over the next 12 months?
Yeah, I can certainly do that for you, Jeff. So since 2017, there's been a couple years where they had as many as 60 wells drilled on this acreage. But really, it's really more average, somewhere between like 10 and 20 per year. So we kind of expect reasonably that it's about 15 wells per year. And unfortunately, because it's a royalty interest, Ryan mentioned we're not going to get a lot of insight from the operators unless this scenario happens where it happens to be something that we have a working interest in, then we would have a little bit better clue that we're going to also have some royalty. But I would say we don't count on that.
Ryan, the economics of royalty production is obviously a lot different from working interest production. How do the margins on this royalty production compare to your existing SCOOP stack working interest and really the company's overall margin structure?
Yeah, I mean, so, obviously that's one of the big benefits of the royalty package, but, specifically to this, on the revenue side, since we are in similar areas, we'd expect, net sales prices and differentials to be similar here as they would in our existing assets. However, on the cost side, right, we think the LOE is going to be really less than half of what we're currently seeing in our working interest position. And really, that's just obviously because on the royalty side, there's really no traditional lifting costs. We really are only paying for production taxes and some charges depending on the lease associated to the gathering, processing, getting really the gas and NGLs and oils to market.
Just to build on the margin concept here, Kelly, how do these characteristics support Evolution's overall total shareholder return framework that you've talked about for a number of years now?
Sure. So, I mean, as you can imagine, both from an immediate impact to cash flow and production and for future results, adding barrels and cubic feet of gas at very high margin really fits our dividend model to a T. It gives us a chance to ensure meaningful cash flows in almost any price environment and tremendous upside during sort of upswings in the commodity cycle when Mark's number of 15 wells or so per year, that could grow quickly in an upcycle with commodity prices. It gives us great access to growth without tying up any additional sort of drilling and completion CapEx. I mean, like I said, for the right price, we certainly think this is a great sort of thing for us to look at. So are other working interest deals. We're going down the dual path for the best deal that's most accretive to the cash flow per share. And this one, I mean, honestly, we think we got a great price on this. So we're excited about it. Fits our dividend model very well.
We often think about commodity prices as being one of the primary drivers of margins. But obviously, like Ryan alluded to on the royalty minerals, operating costs are very important too. Mark, are there other parts or other assets within the asset base where the cost structure improvements could have an or have a positive impact on margins?
Yeah, actually, that's a really good point to make because, we're always talking to our operators and encouraging them to reduce OpEx as much as possible. And I'll be honest, they all are pretty well focused on that and do a good job of it. But currently, like the biggest thing that's really tangible is the decrease in the Delhi field OpEx caused by not purchasing CO2. And a lot of people don't realize the effect that has because we're just now re-injecting recycled CO2, but the cost savings is about $500,000 net to us a month or about $20 per BOE. It's very significant.
So for the same BOE of production, then Mark, the cash flow goes up because of that difference in LOE by a pretty material amount, correct?
That's correct. We pretty much look at that like $500,000 is pretty much basically EBITDA. It's just like an extra EBITDA per month that we weren't getting before.
Do you have a feel yet at Delhi for what impact, if any, just moving to recycled CO2 will have versus the prior operators' practice of injecting or purchasing and injecting CO2 along with what you recycle from the field?
Yeah, so far we've had a small stair-step reduction in rate. It's about 50 barrels per day net to us, or 50 BOE. Well, it's actually BOE per day net to us, and it's caused by shutting in higher GOR wells and also shutting in the most down dip injectors. It helps us to balance the injection withdrawal, so we're not seeing big pressure reductions in the field. And as far as like what'll happen on the decline curve, right? The summertime's a tough time to figure that out because we have lots of operational issues because of the heat, which kind of affects the rates out there because of injectivity of CO2 or the lack thereof because it gets hot. And so we'll have a better understanding of that when it gets into the fall and the winter time. But the thing that I'd like to point out, the biggest deal is that, we had actually had a discussion with the operator when it was Denbury about, the fact that we were putting in way too much CO2 and we didn't really like paying for it because we thought it was like excessive cost to us. Well, we think that the whole deal, and we agree completely with Exxon, the current operator, that this is the most profitable way to produce a field right now. So even if we get a few less barrels, we think it's going to be a lot more dollars net to the company.
In July, Evolution announced the results of an audit at the Barnett Shale, or in the Barnett Shale assets with your operator. Did that audit result in any changes in practices or any real long-term benefits to your cost structure in the field, or was it mostly an accounting exercise?
Yeah, Jeff, I'll handle this one. There were some changes. There were some things in the system that they needed to modify, right, based on the outcome of the audit. So we do expect some benefit, to our netbacks going forward. There was obviously some things in the past and to cover multiple periods, but we do think it's going to benefit us going forward. But the other thing that's probably worth pointing out too that may have gotten lost in the quarter is the gathering contracts were renegotiated by Diversified for the different areas, and we did see some improvement, and we expect to see some more improvement going forward just as a result of renegotiating those gathering contracts.
Ryan, will those improvements show up as better realizations or lower costs?
Should be lower LOE because the gathering costs are booked straight to LOE.
Okay. Production costs at the Tex-Mex assets, which were acquired in March of 2025, and in the Hamilton Dome field in Wyoming, were a little bit high in the June quarter. Do you expect costs in those assets to trend lower in the coming periods?
Hey, Jeff, I'll take this one. And Hamilton Dome had some extra workovers that the operator had to catch up on, which we expect that to decrease going forward, so the costs will drop a little bit there. And then at Tex-Mex, there were a lot of costs associated with transitioning the asset to a new operator, just generally some tender loving care to the assets in the field. And we expect this and the included extra upfront costs, it was all kind of factored into what we paid for the acquisition. So we factored in a bunch of extra costs up front. So we expect over time that the costs will drop out here, and we think it'll be a really good asset for us and generate plenty of cash flow. We also have an opportunity here because the operator has access to using AI program for production monitoring and to help you manage the properties. And so we're actually partnered with them to do that on this field. And if it works really well, like we hope it does, we'll probably talk to some of our other operators about using it as well.
Mark, would the benefit of AI on those assets just mean better uptime, run times, or would it be predictive maintenance or a combination of everything?
All of those.
Okay.
Yeah, I mean, it can optimize your pump jacks, right? When they go, how much they go, strokes per minute, all sorts of stuff, and learn from itself. And it can be pretty cool, save you some money and get better production.
Evolution so far this calendar year closed the Tex-Mex acquisition last spring, and then obviously the SCOOP/STACK deal in July. Kelly, can you share your perspective on the opportunity set in Evolution's business development pipeline as we head toward the end of 2025 and start to think about 2026?
Sure. Yeah. I mean, look, we're seeing some really exciting opportunities out there right now. Like as always, it's going to come down to price, and every deal we look at, I mean, just as a reminder, on a post-money basis, however the financing gets done, it needs to be highly accretive to our cash flow per share. So, this, Jeff, we'll look at 100 deals before we find one that we think is appropriate. But we're getting the pipeline's full. We're looking at a lot of pretty potentially exciting stuff.
Commodity prices have been volatile like they always are, so it's probably not unusual. But does this environment present any challenges either in trying to value assets or structurally and how you work with a potential seller to come up with a transaction that works for both sides?
Yeah, I mean, look, it's different this time. I know that's the old cliche, but I mean, it really is true. And we've got a natural gas market that's trading, on the futures curve well above spot. If you as far out as you go on the futures curve, it's well above spot. And on crude, I mean, as far out as you go there, it's basically right around spot. So you've got sellers with very different mindsets and expectations depending on the commodity. You got buyers for natural gas assets are feeling very different than buyers who are seeking more crude weighted stuff. So you really still have assets that need to move though for various reasons. Yeah, it could be the end of a fund life, could be debt repayment, trading PDP for drilling dollars. Like I said, there's a myriad of reasons why, but there's a bunch of stuff that needs to move, and you got people looking for different things, both on the buyer and seller and by commodity. So when you get this kind of mishmash of stuff, honestly, that's where you can find the really good stuff. So I think we're seeing some great opportunities. Like I said, some of them are quite exciting, but as always, for the right price.
Speaking of deals, the balance sheet at the end of the June quarter had about 35 million of net debt, and subsequent to the fiscal year end, the SCOOP/STACK acquisition was funded with about 15 million of borrowings under the existing RBL. The RBL was amended on June 30, which was right before the SCOOP/STACK acquisition closed, to establish a $65 million borrowing base under a $200 million facility. Ryan, coming back to you, can you share your thoughts on how you think about acquisition financing in the current environment? And maybe since you just went through the amendment RBL or the RBL amendment process, any thoughts on the bank market for a company of Evolution size?
Sure. So the reason we put together this syndicated facility was really to allow us to add, additional lenders if and when we need more debt capacity for an accretive acquisition. Additionally to that, we still have our ATM program in place, and we'll use that strategically to manage our liquidity and leverage and also fund acquisitions. I would say overall, we definitely feel good about the acquisition financing market, and we don't have an issue, funding any accretive transactions. To answer your question on the bank market, I mean, I think it is showing some signs of health, really, in the conversations I've had with various banks out there, there is starting to be some more competition for dollars, especially at the lower end, right, as kind of revolvers at size that we're looking at. So I feel real good about our ability to add additional lenders, on competitive terms if we needed to for the right deal.
Given where the debt level is post the royalty deal, can you share some thoughts on Evolution's free cash flow allocation priorities between reducing debt and the dividend?
Sure. As far as the dividend, we've been pretty consistent in our messaging about how important it is to the company and our overall strategy. I'd say the current outlook, as Kelly's kind of mentioned, for commodity prices, with oil in the low 60s, actually spot gas price and below 350. In the near term, we would focus on probably keeping the dividend flat and repaying debt to reload the balance sheet for more acquisitions. But overall, our strategy continues to be to increase the dividend over time, and we'll continue to, like I said, evaluate and transact on creative acquisitions that we're seeing in the market. And we think our track record of completing these types of acquisitions, combined with our existing asset base, is definitely going to allow us to raise the dividend over time as sort of commodity prices increase and as we're able to execute on our strategy.
Yes, it's worth pointing out that dividend consistency has been a mantra of the board and management, and most recently Evolution declared its 48th consecutive dividend at the rate of quarterly dividend at the rate of 12 cents a share, so a 48-cent annual dividend. Kelly, coming back to you, with 2 acquisitions closed in the past 6 months, can you summarize your thoughts on how those 2 deals support Evolution's ability to deliver cash flow and execute some of the things Ryan talked about? And coming back to bring us home with how they support your total shareholder return framework.
Yeah, I mean, you kind of hit the nail right on the head with your question. I mean, truly, the additions of Tex-Mex and our SCOOP/STACK minerals They were done to do exactly that, to support our free cash flow, to support our dividend, and bolster our total shareholder return focus. So both these transactions, once fully integrated, are specifically designed to put more cash flow into the company than they take out via their existing production. And yet each of them still can provide meaningful upside for many years to come. I mean, one of them, Tex-Mex, a little bit of traditional operating TLC, as we like to call it, and reactivating some shut-in production, which is much less capital intensive than having to go drill new wells. And the other one, obviously the minerals, it has, scores of locations that, are operated by and right in the drilling corridor of some of the best operators in the entire Scoop Stack. So, listen, we're going to get future benefit of those with no drilling costs. So you got low cost and no cost sort of upside in addition to the great current cash flow that these provide. So we're excited about that. I mean, I'll say, look, these deals, along with the rest of our portfolio, set us up both to ride out any sort of softness in commodity pricing, but also that they put us in a position where we can reap massive benefits when pricing is strong. So truly, Jeff, on a risk-adjusted basis, where we sit today, I think it's in about as strong of a position as we've ever been. And we're really excited about fiscal 26 and going forward.
Well, I want to thank you for joining us today, Kelly, Mark, and Ryan. It's good to follow the company as you execute the strategy and continue to build out your diversified asset portfolio in support of dividend strategy.
Yeah. Listen, Jeff, we always enjoy talking to you and getting a chance to spread our message. So thanks again for the opportunity. Really appreciate it.
Yeah, thanks, Jeff. Appreciate it.
Appreciate it.
For our participants, thank you for joining us today for a fireside chat with Kelly Lloyd, Ryan Stash, and Mark Bunch from Evolution Petroleum. Our research can be accessed from our website, www.watertowerresearch.com. The views expressed on this fireside chat may not necessarily reflect the views of Water Tower Research LLC and are provided for informational purposes only. This fireside chat may not be distributed, reproduced without the written consent of Water Tower Research and should not be considered research or a recommendation. WTR is an investor engagement firm, not a licensed broker-dealer, market maker, investment bank, underwriter, or investment advisor. Additional disclaimers can be found at our website, watertowerresearch.com. Once again, thanks everybody for joining us.
Thank you.
Hey, Jeff. Bye-bye.
Thank you.